And hope you can see my screen as well. Can you? Can you see my screen here?
Yes, sir.
Right, great. So this could be the last topic we are going to talk about, or we are going to discuss on operations management. And the handout is uploaded to the LMS. You can find it, and that is inventory management. Okay. So I'm looking for a remote controller here because temperature is not so appropriate. I could find it. Right. Since we don't have any physical students here, let's try to complete the main part of it only through online. And in operations management, as you can, or as we have been discussing so far, we discussed the responsibilities of operations managers, different decisions they involve. So this is one such important decision that has become challenging in modern markets as well. Right? You can put your hand down. There are five. So put your hand down. So as you see it here, the learning outcomes for the topic, that is to identify the need for inventory management in modern manufacturing industries. And then also identify the inventory management related concepts and what we call inventory costs. Then we also try to identify the key inventory management related activities that are commonly being practiced in industries, and then describe different inventory management approaches and techniques at the basic level so that you can quickly understand some of the basic techniques used in inventory management. So this is the content we are going to complete within 2 hours or so. So first of all, let's identify in manufacturing management or in operations management why inventory management is important. Right? And prior to that, let's define how can we let's define the inventory and identify how can we describe inventories in operations. Right? As you see it here in slide number 3, broadly what we call inventories can be defined as the stock of any item or any resource that are used in operations, that are used in organizations. Right? So the stock of any item that we consider as stocks, but coming to operations, there are only few types of inventories or few types of stocks that we usually deal with. Operations management, more specifically, inventory refers to stock of goods and materials used in operations. So then there can be different types of stocks. Mainly, as you see in slide number 3, there can be raw materials inventories, materials and components that are used in production. They should be stored, they should be managed until they are used in the production. Second type of inventory, we call it WIP inventories, work in progress inventories. So that can be seen in factories at different production steps, at different departments, until they are put together, assembled together, and complete the final product. In the same manner, there can be third type of inventory, we call them finished goods inventory. Those are the finished products, those are the outputs of the processes, output of the operation system. So depending on the industry, say for an example, in a biscuits factory, that could be the packets of biscuits packaged and packed together. In a garment factory, it could be finished garment items, nicely completed and ready to dispatch. In case of electronic devices like refrigerators to televisions, it could be the finished items that are ready to send to the market. So likewise, there can be finished goods. In addition to that, there can be other supply items. We will identify them as MRO items later. We call them supply items. They're basically not for selling purpose, but maybe the spare parts of some of your machinery, or maybe fuel for your generator that is used for the energy. So supplies like those may also be maintained in inventories, right? So there are such inventory types in operations that I will describe again later. But coming to inventory management, that is very important in managing operations smoothly. So they have to make sure that factory managers or businesses should make sure that they have a smooth flow of items from raw materials to work in progress items to finished products. And for that, one traditional way that businesses manage their supply is through inventories or inventory management. So it's all about keeping adequate inventory levels at different places of the supply chain, at different places in the production process, to make sure that you smoothly supply to the market and fulfill customer requirements. That we call making sure your products are available when customers need them, when your supply chain partners like wholesalers, distributors require them, and thereby maintain higher customer service levels. Now, that is one objective, in fact. But on the other side, especially being applied accounting students or cost or financial accountants or managers involved in managing cost, when managing more inventories, there will be additional costs. We call them inventory costs. Right? So to maintain inventories at different levels, like raw materials, work in progress, and finished goods along the supply chain, a company should make some investment into it, inventory investment. You will have to invest money or the resources for maintaining inventories. That investment would be very high if a company maintains very high inventory levels. That is the issue. To make sure that the company is maintaining higher customer service levels, they have to maintain high level of inventories. But when the inventory levels are high, the investment would also be high. So the purpose or the objective of inventory management is to strike a balance between inventory investment and customer service level, and thereby you make sure you fulfill the market demand on time without any failure, while minimizing the inventory related cost or inventory investment. And for that purpose, businesses manage inventories through various different techniques, methods, approaches, systems. such we know, such we consider as inventory management systems, inventory management approaches, inventory management techniques. Right. So that is it. I hope you understand. Now, hereinafter, I will try to explain you some of the key inventory related concepts like different types of inventories. Then, of course, inventory costs. And then what we mean by inventory optimization. And then different inventory management techniques and approaches. I hope that is clear. What did we discuss? We just identified that in operations, inventory management is an important area. So, especially in manufacturing industries, when it comes to make sure that their supply is continuously maintained to the market, they have to maintain inventories of different types. We'll discuss them in detail again. And then the purpose of inventory management is to maintain a balance between higher customer service levels that is available or making sure that your products are available, and on the other side, minimizing inventory investment. So, is there any quick questions from you before moving further? Since we don't have any physical participants here or students physically here, we'll have asked some questions by unmuting yourself. Let me see whether I can see the messages. So, usually can send messages also, but I don't see that option here. Anyway, you can unmute yourself and ask questions if something is important. Is there any question, or shall we move forward?
No, sir.
How about others?
No, sir.
Right. Well, sometimes, especially in modern markets that are highly competitive, and then you see there can be new management concepts. No? Very often, manufacturing industries, to be competitive, they try to, in one hand, try to produce quality products, and at the same time, they try to minimize operating costs, production costs. So when they try to improve both, like improve the quality while reducing cost, there are certain management, operations management approaches, operations management techniques used, such as lean. You may have heard of it, lean management systems. And based on that, in line with the same approach, there is this supply chain system, we call it just-in-time systems, JIT systems, where they talk about keeping minimum inventory levels. Or in other words, just producing the right product, only the right quantity, without maintaining additional inventories, so that they can minimize their investments on inventory. That would result in low operating cost. What I can explain you here is that in addition to traditional business management approaches or operation systems, there are latest operation systems, we call them lean operation systems, where we see just-in-time kind of approaches that they try to maintain minimum inventory levels and only supply what is required in the market. Then they start production only when they get the orders from their clients. So in such a context, one might ask, are these inventory management concepts, inventory management techniques are applicable or useful? Well, there are certain instances, there are certain industries where such lean practices are introduced now, lean, just in time, right, and various other. However, most of the other industries are still continuing with the traditional operations management and supply management concepts. So, in those traditional operations systems or supply systems or supply chains, the same traditional operation or inventory management concepts are applicable. On the other side, even in industries where they practice lean or just in time, over a period of time, they have realized now just maintaining zero inventory would not be a good idea, because sometimes in the market there can be, in the supply chain there can be some, as we discussed on supply chain management briefly, there can be some supply chain, we call them disruptions, supply chain problems, like there can be supplier delays, there can be logistics issues, there can be transportation delays, right? So what if you still have, you only have the just in time arrangement only. So you won't be able to face such sudden disruptions happen in the market, taken place in the supply chain without maintaining any inventory levels. So now most of the industries have started thinking how to combine the modern lean systems or just-in-time systems with the traditional inventory management systems and maintaining inventory levels at an optimal level. They call it optimizing the inventory management or optimizing the inventory levels. And for that, they talk about keeping inventories at different places and then optimizing them. Right? So that is where they are now. So even just-in-time practices or lean practices encourage to maintain some amount of inventories to make sure that the company can smoothly supply to the market in case of supply chain disruptions. So in such a case, most of these inventory management concepts, inventory management systems and practices are highly relevant even in today's competitive markets. I hope that is clear. With that brief introduction, let's move to the basic concepts that are lined up here. Like we started with slide number 4, where we identify different types of inventories. I hope that is clear. Any quick questions? Seems no. There are 30 participants here. There shouldn't be more signatures than that. I will take a record of participants here and then take only the attendance participated here. Right. Seems that you don't have any questions, so let's move forward. As I already explained to you, there are different types of inventories to be managed. So as you see in slide number 4, there are 4 types of inventories. One is called raw materials inventories, which are the materials and components purchased but not processed yet. They could be items that are ordered from your suppliers in transit, or items they delivered to your warehouse. In raw material warehouse, you may have raw materials inventories maintained until they are used for the production. Like a garment factory maintaining fabric inventory, biscuits factory is using flour, sugar, oil, and various other ingredients. So likewise, so raw material ingredients. Whereas the second category, WIP, those are the inventories maintained at different production steps as work in progress until they are sent to the next level. So in a production process that are connected to each other, they are supposed to maintain some amount of work in progress to make sure that the processes are smoothly connected and the production steps are smoothly taken place, smoothly operated. In addition to that, the finished goods, those are the completed products ready to send to the market, awaiting for shipment. That would be the normal production levels, normal inventory levels, plus additional seasonal stocks they produce to supply to the fluctuating market demand, or any other anticipatory stocks, maybe safety stocks, right? Or maybe other anticipatory stocks that businesses would maintain to absorb the market fluctuations. In addition to that, the supply inventories, we call them MRO. Those are maybe spare parts of your machinery, or any other supply items like fuel for your generator or oil for your machinery, right? Which are necessary to keep your machinery and the processes productive. We call them maintenance, repair, and operating inventories, MRO inventories. Not for selling purpose or not for reselling purpose, but for consuming them in the production processes. Then coming to the main part of our discussion, for what purpose inventories are maintained? We call them, what are the roles of inventories? Or in other words, what are the functions of inventories that are of various types? What an operation system expect? What a business would expect from inventories? We call them functions of inventories, the roles of inventories. There are a few points that I have mentioned here that I have taken from textbooks. Very clearly they explain inventories perform more critical roles, more critical functions in business. That is why without inventories, it's very difficult to manage operations. So certain points are mentioned here. Let's take one by one quickly and I understand them as we move forward. The first point mentioned here, that is to provide a selection of goods for anticipated demand and to separate the firm from fluctuations in demand, In any consumer product, like biscuits to chocolates to beer to consumer durables like televisions to refrigerators. Now, the demand for such products may be fluctuating in the market. There can be seasonal demands, certain months, certain quarters, where the supply or the inventory demand would be fluctuating over a period of time. To make sure that they can absorb the market demand that is fluctuating, they will have to maintain some amount of inventories that we call the function of inventory, that is to provide a selection of goods to anticipate the demand. So when customers look for products, products should be available. That role is performed by the inventories. Otherwise, what happens? When customers really look for products, if products are not available as inventories, production processes would be pressurized. They will have to start production and complete production and send to the market. Through inventories, especially finished goods inventories, businesses can separate the market demand from production. So they can separate production from market demand rather. Because by supplying the right products through the inventories, they can independently maintain their operations without much worrying about the market fluctuations. They are operating with inventories. So that is the meaning of separate the firm or the production processes from changes in the marketplace, like fluctuations in demand. Then that function is made relevant for finished goods inventories. I hope that is clear. To provide a selection of goods to fulfill the market demand and to separate the production activities or the production system or the firm from fluctuations in demand, we call it. Likewise, there are other roles, other functions of inventories as well. Hope you can go through. The second point mentioned here, we started inventory management topic. We are halfway through. Right? You are here. Right? Go through the first part of it, understand the first. So, second main point mentioned here, to separate or to, we call it, to decouple the production steps in the production process. We use inventories and thereby maintain independence of production steps, independence of production processes. Right. This function is particularly relevant or applicable for work in progress inventories, WIPs. At a factory, assume that a tire factory producing tire. If you have been to a tire factory, you may have seen there are few steps in the tire production process. Initially, beading is manufactured, and then the rubber compound is processed, and things are processed together, and then the burning part or the making part of it and completion part. So in those different steps, only if they maintain WIP inventories adequately, they can continuously operate the process. Otherwise, one process should be stopped until the previous step is complete. Through maintaining work in progress inventories, we can separate the production steps and minimize the interdependency between production steps. That's an important role played by inventories. What is the term we use here? We call it decoupling the production steps. Or separating the production steps and maintain the independence of operations, which is very important. And then the third point here, that is specifically applicable for raw materials inventories. The role or the function of raw material inventories, that is to allow flexibility in production scheduling, Production scheduling, that means according to the production plans, how we are going to manufacture the orders. You have to arrange the production process. We call it production scheduling. When raw material inventories are maintained for different products, one factory is producing not only one product, they will be producing different products, different designs, for which different materials are required. When factories are maintaining, when raw material inventories are maintained at factories, they can flexibly design which order to prioritize, and then you can schedule which order likewise. So the production scheduling purpose, keeping raw material inventories is very important. So that is another key function played by inventories, especially raw material inventories. We call it to allow the flexibility in production scheduling. So those are the three main functions of inventory. First one is from finished goods inventory. Second one is from WIP inventory, and the third one from raw materials inventory. Well, other three are common functions of inventories, and that you can simply understand. Fourth point, by maintaining inventories, companies can take advantage of certain economic advantages like quantity discounts and maintaining economic order sizes that gives you some economic advantages. You know, when businesses purchase in large volume, in bulk, they will be allowed for better rates, discounted prices. To get the discounts, quantity discounts, when you buy high volumes and maintain the additional amount in inventories until they are required, you can buy products at lower prices, lower rates, especially by ordering at economic order sizes. You can minimize inventory related costs, but you will have to maintain inventories. So to take advantages of quantity discounts and then advantages of economic order sizes and all, inventory management has been unified. That is another main function of inventory. And at the same time, there can be certain supply chain inefficiencies, problems, issues, like there can be delivery delays from your suppliers. If you don't have raw material inventories to start the production, and if there is a delay from manufacturers or supplier side, you'll have to stop the production. To avoid such issues, companies maintain inventories. That is another function of inventories, to provide a safeguard for any supply chain inefficiencies, such as delivery delays or logistical problems. In addition to that, we can also identify another role of inventories, like to face the risk in the supply, especially we call it to hedge against inflation. Product prices, especially in an inflationary economy, inflationary market, where the product prices are increasing day by day, weekly. Idea here, hedge or forward buying refers to one common practice, right? Forward buying. That means knowing that in future your demand is certain, you need these materials, you need these components, you buy them well in advance at a lower price, because when there's inflation, the product prices seems to increase faster, quickly. To get the advantage, you maintain inventories which are purchased at lower prices, and then take the economic advantage of and you make sure that you can supply to the customers within the standard costs. So likewise, there are basic functions of inventories. What I have explained here are 6 main functions. There can be many other that you can identify from textbooks that you can understand. Is that clear? This part of the slide, we identify what are the roles of inventories, what are the functions of inventories. Any quick questions? Any quick questions? Do you know any reason why others are not here? Not probably any particular reason, right? Only this lecture is there today. We don't have any other yeah.
So today we have that political celebration and only this lecture. So that's why.
Can you just explain it? What was the reason? Hello.
So today in second half, we have that Pongal celebration in the campus.
Mhm.
The only lecture,
So, are you going to take part in the Pongal celebrations or not?
yes, sir.
If you're in the
That's why most of the
celebration,
students are joining the online.
so anyway, luckily you had this option. Otherwise, I could have decided to cancel the lecture. Anyway, thank you for that response. Is it clear? Functions of inventories. And he explained it briefly. I hope you can understand. Shall I move forward then? Coming to inventory management, this is one of the key concerns. You know, in one side, when you maintain inventories, you have more benefits, more advantages, so that businesses would like to maintain high inventory levels, but businesses are reluctant to do so because higher the inventory, higher the inventory management cost. So when identifying different costs relevant for inventory or associated with inventory, we basically identify the first, the first three types of costs. Basically, two types. In manufacturing, we said, now main type of cost involved in inventory management is the inventory carrying cost, or what we call inventory holding cost. And the other type of cost is called ordering cost. Those are the two costs. Coming to manufacturing industries, manufacturing activities, instead of ordering cost, what is applicable there is what we call setup cost. When you change production process from one product to another, they will have to rearrange the production process. They will have to set up the production process. That involves some amount of cost. So in manufacturing industry, instead of ordering cost, what is applicable there is setup cost. So those are the two types of costs. Inventory holding cost or carrying cost. Second one, ordering cost or setup cost. Those are the two main types of costs. In addition to that, in some advanced inventory management calculations, we can also refer to the other type of additional costs like stock out costs or shortage cost. Or alternatively, what we call back ordering cost, which refers to a situation like if you are unable to supply due to supply shortages, there can be lost sales, lost opportunities that we call stock out cost or shortage cost. If you can quantify such cost in monetary value, in rupees, in dollars, we can also consider that in calculating the inventory management levels. What we mean by backordering cost here, in a similar situation, if you are unable to supply to the customers because no stocks available, you will have to delay the supply. You'll have to backorder the supply. So that means you are unable to supply now, but you will supply later. That will also involve in some costs like customers maybe not willing to accept some delayed orders, or sometimes whether they agree. Next time they will not come to us. That will affect our reputation as well. Customers will be disappointed because of back ordering. Likewise, there can be some cost involved in supply shortages or when you are unable to supply on time. So in advanced inventory management calculations, in addition to the first two types of costs, stock out costs or backward costs are also considered. I hope you have an idea. What we call inventory carrying cost or holding cost. Costs associated with inventory management, inventory or keeping inventories for a long time period. So can you think of some examples, some specific cost categories that you can identify as examples for inventory holding cost or inventory carrying cost? Basically, it could be the warehouse rent or the inventory maintenance cost, mostly. Right. When you want to maintain more inventories, you need more space. The warehouse cost. So space requirements would be high. So the cost would be higher. That is only one type of inventory carrying cost. There are other types of costs as well, like what? Inventory handling, material handling, inventory handling cost could be another type of it, like labor charges, moving from one place to another, inventory retrievals cost, coming on inventory carrying or inventory holding cost. More than anything else, there can be inventory losses, product depletion, product outdating, product expirations. So such costs are also coming under inventory holding cost, product expiration, and they are maintaining stocks. In addition to that, there can be insurance cost. Inventories should be insured. Cost of them can be added as inventory holding cost. And in addition to that, you may also add inventory tied up capital in inventories and the interest of them. So longer the period you maintain inventories, higher the amount of inventories you maintain, higher the inventory holding cost. Hope you get it. So businesses would try to optimize inventories to minimize inventory holding costs. I hope that is clear. That is about one type of costs, inventory holding cost or inventory carrying cost. Second main type of cost, we call it ordering cost. Whenever a new order is placed, when new order is processed, the cost related to that process. Documentation, sourcing and documentation, order processing, plus even specific transportation costs for each order if that is available, coming under ordering cost. So if a factory order many times, the number of orders, frequency of ordering, how frequently you order, more the orders, right, more number of orders you place, higher the cost. If you can minimize number of orders, you can minimize ordering cost. So that is the idea. So as in setup cost, like it behaves like ordering cost in manufacturing. As I explained to you earlier, in the production process, say for an example, like in a shampoo manufacturing process, assume that they are producing 200 milliliter bottle now, right, in a batch. that they continue for few hours or 1 or 2 days to complete a batch. And then after that, they start producing 400 milliliter bottles. Now they will have to stop the production, change the production process and rearrange it or set up it to make or to manufacture 400 milliliter 400 milliliter bottles. We call it setting up the process. That takes time, that involves cost. More number of times you stop and reset up, higher the cost. So they have to make sure they manage that cost or that type of cost as well when managing inventories. More setups, higher the cost. We call it changeover cost. Process changeover cost. More the changeover times, higher the changeover cost. Like the ordering cost, it behaves. I explain you the stock out cost and back ordering cost. So hope we have some examples for these different inventory costs relevant. Now in inventory management, like in any other operations decisions, here the purpose is to maintain appropriate inventory levels while minimizing inventory costs. So that is what we try to understand. And for that, there are different inventory management related activities. In fact, this is what I just want to explain to you as the main part of inventory management. So there are many different inventory management activities that I have divided into few categories as shown in slide number 7. So they recognize them as key activities of inventory management. There are many inventory management activities that operations managers involved, factory workers involved, warehouse managers and staff involved. So I have mentioned a few of them here as key activities of inventory management. Oh. Right. Hope we are ready. Shall we quickly identify some of those key activities? Mainly in inventory management, they are responsible for classifying inventories and specifying inventory policies for different categories. Classifying inventories. And more importantly, inventory management related activities. One could be inventory determination and control. That means specifying what are the different Inventory types you have to maintain. We call them stock keeping units. Specifying stock keeping units, SKUs, for inventory items, and decide where they should be maintained. We call them stock points. So inventory determination, that is specifying SKUs for items and where they should be maintained, stock points, and controlling those is another main activity of inventory management. However, the main task of inventory management is to design and manage inventory management systems depending on the requirements of the business, understand the market requirements as well. For each SKU, whether that is finished goods, whether that is raw materials, those are the main types of inventories that are particularly managed. For them, inventory managers should design inventory management systems. There are different types of inventory management systems. In fact, later we will identify some of them, basic systems, and some advanced systems are also there. So, for example, like for certain SKUs, designing EOQ level, pre-order levels, and etc. Coming under designing inventory management systems, that means the procedures to follow with respect to each SKU. I will give you more details later. So these are the three main inventory management related activities that are commonly seen, commonly available in all the industries. In addition to that, other activities like inventory documentation, managing inventory documentation, that is keeping accurate inventory records. And for that purpose, using proper systems for inventory documentation and inventory management. It could be manual systems like bin cards and various other manual systems, or information systems like WMS, warehouse management systems, right? Software, information systems to keep records and update them real time. Right? So that comes under inventory documentation and inventory maintenance, record maintenance. Is another key activity of inventory management. Then, of course, physically managing inventories with the support, with the use of facilities, systems, and staff like warehouse management, warehouses, inventory managers, support staff, and systems for that. Also coming under inventory management as a key activity of inventory management. So those are the common and most important inventory management related activities that we can identify in businesses. Are they clear? We are going to discuss some of them in detail. But go through these key points and check whether you can understand them. Is it clear? Different activities of inventory management. These are some questions if some points are not clear. Okay, go through this area and ask some questions if any. You may see in past papers questions like describe the importance of inventory management in selected industry. You may select the manufacturing industry or even some service industries. So service industries are inventory management important. Inventory management related activities are important. You might take an example from manufacturing industries like consumer products or consumer durables or industrial products and explain why inventory management is important in managing the operations. I'm asking the same question again now. It's very clear in manufacturing industries, inventory management is highly relevant because they produce products, they maintain finished goods inventories, and to produce products, they use work in progress and then also the materials and components. So they have to maintain inventories in manufacturing industries. Is inventory management relevant for service industries? What do you think? Hello? Is inventory management applicable? Service industries. Service operations. Any answer? Those who are connected online. Is inventory management like classifying inventories, determining inventory control systems, identifying SKUs and stock points, designing inventory management, keeping records of inventories, managing inventory related infrastructure like warehouse facilities, systems and staff. Are they relevant for service industries? Any good guesses? Services? Yeah, anyone who can okay. Then think about it and be ready to answer a question like that. Someone is asking or answering. Why should I worry about it?
Yes, sir, they are relevant.
I'm sorry, can you just repeat it?
Yes, sir, they are relevant for the service industry also. So,
Why do you
uh,
think so?
because even the service does not sell the physical products, they still rely on the inventories such as supply, material and spare parts, and sometimes information or capacity like inventory classifications that as we take a hotel industry, that linens, cleaning supplies likewise.
Of course, yes, your point is very valid. Now, for a moment, keep certain examples you mentioned, like information aside, but in many other, all the other examples you mentioned here, like supply items, especially in certain service industries. Right? I mean, inventory basically refers to physical items. So keep inventory, information aside, but other items you mentioned, which are important in certain service industries, right? And for maintaining them, inventory management activities are relevant for service industries as well. Yeah. One example could be, as you correctly mentioned, in hotels, restaurants, right? Maintaining adequate food categories, inventories, ingredients in order to supply their services smoothly. Various different food items, beverage, right? And then of course coming to hotels, linen and various other supply items required to smoothly maintain service processes, right? That are important. Then maybe in an institute like education institute, and relevant books or stationaries, right? And various other physical items that are important, maybe even supply materials like water bottles to various other Very important. Coming to certain industries like retail services, retail businesses, like supermarket chains or online market platforms, like Daras or Temu or Amazon. So their business is a service industry, but mainly to retailing. So to make sure that they can fulfill customer orders without any delay, they have to maintain adequate inventory levels of various different SKUs that they supply to the market. So your point is valid, especially in certain service industries. As you correctly pointed out, though they do not provide ultimately a product, right? To provide their service, they may heavily depend on some supply items, materials, ingredients. So for that, they should also maintain inventories, and most of these inventory management concepts are equally relevant. We see these inventory management activities in some of the service industries also. Good explanation. Right, any other questions? No. So then we have around 1 hour or so. I will take a 10 minutes break, but after that I will discuss some of these selected inventory management activities, like the first one, inventory classifications. So what are especially this technique called ABC analysis, ABC classification, and accordingly specify inventory policies accordingly. And I will also show you, discuss with you some inventory management systems and the basic economic order quantity models and some calculations, at least we have to do. Probably I will not discuss other things in detail, like inventory documentation part of it, inventory management systems, like warehouse management systems and all the digital options available. And I'm not going to discuss things here, but on the ERP module, as an ERP module, warehouse management systems and other things would be discussed in detail. So after a small break, we will start with ABC classification, one of the main inventory classification technique we see in practice, and then some of basic inventory management systems like economic order quantity models, and some of the calculations that we will discuss as a final part of our topic. I'll take 10 minutes break. I will start around 10. Okay. So where you come? Students supposed to come for the local festival here around 5.
Excuse me, sir.
Yes.
Sir, I can't mark my attendance. Can I get my attendance?
Why you can't mark your attendance?
So it's connection issue, sir. That's why I can't make my attendance. Now.
Okay. We'll give it a try. Wait till the end of the lecture and remind me.
Okay, sir. Sure.
Your attendance.
Yes.
අවසන් තියෙන උත්සවයට කට්ටිය ලෑස්ති වෙලා දෙන්න ඕනේ කියන්නේ. ස්පෙෂල් එකකට ලෑස්ති වෙලා දෙන්න.
නෑ වේස්ට් එකක වේස්ට් ඒක කරලා තියෙනවා. ඒක තමයි.
We can go through the recorded lecture for the first part. There was a person, I could recognize the name, who wants to mark the attendance. Is that person here? The, here?
So, attendance is not working, sir.
Um, What is your number?
030.
Harishan? 030,
Harishan.
13 or 30? 30.
30. 30.
From the normal batch, right?
Yes.
Harishan.
Harishan, yes.
Right.
Thank you, sir.
Right. Shall we move forward? There was one person here. Aparadya, listen, I mean, listen. We were talking about inventory management today. We identified why inventory management is important in operations management, and also identified some key concepts used in inventory management, like different types of inventories, different inventory costs, and then we also identified the functions of inventories in operations management. And after that, we also identified the key activities coming under inventory management that we are going to discuss at least two of them now after the break. Hope you all are there. There should be only small number. Maybe. Right, then let's start. As I told you before the break, I will start with this inventory classification techniques. There are different techniques. You may be familiar with 2-bin systems, 3-bin systems for inventory management purpose. Those are basic systems, basic classifications. But there is this ABC classification. ABC classification that is explained in textbooks, that has been used in practice in many industries. So ABC analysis or ABC classification is a inventory classification method. As you can clearly understand, this is used to divide different types of inventories, especially different inventory items, into 3 categories, 3 classes, based on one factor, that is based on the annual volume and the value of each item. So what are the 3 classes we divide inventory items? That is class A, class B, and class C. Considering total inventory items, we call different SKUs in the business, stock keeping units. Based on the annual dollar volume of each SKU, we can divide them into 3 classes, like class A, class B, and class C. in which class A has items or SKUs that are of high value. And accordingly, more rigid inventory control procedures will be more strict. Inventory management controls procedures will be used for items coming under class A. Then class B includes the second level of, the next level of items based on their dollar value. So we call it medium annual dollar volume. Some other items, there are percentages or the standard ratios, standard benchmarks for each category. I'm just introducing you class A, class B, and then class C. This is the class C that most of the less expensive items, the majority of them are categorized. So very basic or minimum inventory control procedures are maintained, implemented for class C items because they are less valuable. As you see it here, ABC classification or ABC analysis is a kind of technique we use to divide inventories, SKUs into three levels, three classes based on the annual dollar value. And accordingly, establish different inventory management procedures, policies, especially for critically valuable items and simple procedures for less valuable items, and thereby manage the inventory management responsibilities practical. As you see it here, more strict policies will be maintained for class A items, and then they will also work on supplier development for A items and tighter physical inventory control for A items, and more carefully forecasting the demand for A items and then managing inventories for A items seriously. Relatively low attention will be given to class B, but still there can be certain inventory management policies and other concerns. Coming to class C, these are the less valuable items that will be managed without more strict policies and procedures. To get an idea, this is how it is explained in textbooks. In terms of number of items we have and the annual dollar value, right? Items that are less than 10% of total inventory items, that accounts for around 80% of value. Figure items less than 15% of total items that are of high value, around 80% of value, classified under A items, A category. Then the next set of items, very low, right? B items, the next level of A. So B category, B class, the next 30 to 35 items, 30 to 35% items in terms of dollar value, annual dollar value, it could be somewhere around 13 to 15 to 18%, somewhere there. Less than 20%. Could be around 12 to 15% in terms of dollar value. But in terms of items, it could be 30 to 35% of items that are flexible. Coming to C category, all the other items that are less valuable, less expensive, classified under C category, there could be around 50 to 55% of items. Altogether, that would result in 5 to 8% of value. 5 to 8% of value. So those are the benchmarks. Those are the criteria we use to classify SKUs into three classes. Is that clear? Class A, highly expensive items. Out of the total value of inventories, 80% comes from A items. 80% of value. But in terms of items, it could be less than 50% of items. Class B, around 10 to 50% of value of total inventory. But in terms of items, 30 to 35%. Remaining under class 3. With an example, let's quickly try to identify how to do this calculation. That is, there is one example is slide number 10. Assume that you are provided such SKUs, various different stock items that are given numbers, right? Stock item number. And then the volume they consume for the year, annual volume, and the cost of each unit, the price of each item. To make the example simple, only how many items? Only 10 items are mentioned here. Assume that they maintain 10 SKUs, 10 items in the stocks. And the annual volume requirements or volume handle is given with the unit cost of each item. Now, if you are asked to consider this information, details, and classify them into A, B, and C, how can you do that? Based on the benchmark measures we identified above. That's a very simple thing. What you have to do is you have to by using the annual volume and the unit cost. First of all, you have to calculate the annual dollar value of each SKU and arrange them from descending order, most valuable item to least valuable. That you see in slide number 11. See. Now, the calculations are mentioned so you can easily understand it. Now, when you multiply the annual volume by unit cost, you get annual dollar volume. And when you arrange them in descending order, most valuable to least valuable, you get answers like this. Now, stock items, when arranging from the top, right? So, when you multiply 3 into 4, you get column number 5, that is annual dollar volume. We started, right? Hello? We started. So then apply the criteria we discussed. And for that, we need to calculate column number 6, that is a percentage of annual dollar volume. So out of the total volume here, 232,000 amount, right? That is the total inventory volume. Right? Dollar volume. Out of that, what is the percentage of each SKU that you have to calculate? And that is shown in column number 6. So the first item accounts for 38.8% of annual dollar volume. Second one, 33.2% annual dollar volume. The third item, 11.3. There's a significant difference between item number 2 and 3. So when you add the total percentages, like the first two items, when you add these two items together would account for around 72% of total volume, total annual dollar volume. And if you add third one also, that goes beyond 80%, and you clearly see a drastic difference between item number 2 and 3, so that you stick to the first two and classify them as only the class A items. That accounts for around 72% of value. As a percentage of items, it's around 20% out of this. So accordingly, you identify these two as class A, because according to criteria, according to criteria, around 15% of most valuable items. Sorry, out of total, around 15% of items, and in terms of value, around 80% of it. So together, these two accounts for 72%. So we classify them as class A. The next, that is out of the total value, around 10 to 15%. And in terms of items, 30 to 35%. So let's say it's around, they have included the next three items into class B. Together, it accounts for 23% of value, 23% of volume, dollar volume. And then together, 30% of number of items. The remaining items are classified under class C. With this simple example, and with the answer here, hope you can understand, if you are given such details, like various different SKUs, their annual volume, and the cost of unit, hope you will be able to identify annual dollar volume of each SKU and arrange them in a descending order, and accordingly using the ABC benchmark criteria, you will be able to classify them into three classes: class A, class B, and class C, and accordingly specify inventory control procedures for each. What are the procedures? Strict control over the items coming under class A, somewhat lenient inventory control procedures for items coming under class B, and very basic or minimum or no and very basic control over items coming under C. I hope you can have a simple idea. What is the technique? We call it ABC classification. Based on the annual dollar volume, the rupee volume of inventory, we can classify inventories into three classes. That is one of the common inventory classification model. I hope that is clear. With that, let's move to one more area, like that. This could be the last area that we are going to discuss. That is inventory management systems. There are different types of inventory management systems. I will quickly take you through few, or at least one, inventory management systems. So there are different inventory management systems or techniques. The most basic or the commonly used technique is known as fixed order quantity approach, where we talk about EOQ, basic EOQ models, and EBQ models. In addition to that, for some inventories, in some industries, there is this approach, we call it fixed order interval approach, that we will not discuss with you today in this program. And in addition to that, there are other inventory models like single period models. Second one is applicable, fixed order interval approach is applicable for items that are frequently refilled with regular intervals, maybe after a few days, after a few weeks, you refill the inventories. Single period model techniques are applicable for items that have the different types of demand. The items are required only for specific period. You don't have to maintain more inventories after that. In such a case, single period models are applicable. We will not discuss those two, but we will discuss the first one, that is called fixed order quantity approach. That is the most common basic inventory management system that we see. fixed order quantity approach that is known as EOQ models or EBQ models. This is popularly known as EOQ model that has been developed based on certain assumptions. I hope some of you are familiar with this. So basic EOQ model is developed based on many assumptions. So, most of these assumptions are not realistic. But this model is based on these assumptions. That they believe the demand for the item that we want to maintain, the inventory item, SKU, the demand for it, annual demand is known clearly. And that is constant. That is not changing over a period of time. That is constant. And that is independent. That is independent from any other factors. You know the demand for that item clearly and confidently. And then they have another assumption like lead time is known and constant. Lead time, the time gap. When you place an order, when you get it, time gap is known. You know it, and that is constant. That is not changing. That is another assumption. So likewise, there are other assumptions of the EOQ model. Quickly go through. They assume the receipt of inventory is instantaneous and complete. That means when you place an order, within the lead time you get the total order, total quantity at once, not part shipments. You get it fully. It also assumes, basic EOQ model also assumes no quantity discounts are given. No issue how the order size, you get the same price for each item. No quantity discounts for higher volumes. That is another assumption of basic EOQ. Only two types of costs are considered here. One is holding cost, and the other one is called ordering cost or setup cost, as we already identified. Both are ordering cost is applicable for trading industries. Setting up cost is applicable for manufacturing. So only two types of costs are applicable. One is holding cost or carrying cost, and ordering cost or setup cost. In basic EOQ model, they believe, they assume stock outs can be completely avoided, no stock outs. This is a very simple model. And accordingly, as you know, this is how inventory, each item, inventory levels would be behaved like this. That's the order quantity that you order. It's called Q. When you order that amount, you get the total order once. So that total or maximum quantity inventory level equals to the order size. Maximum inventory level equals to the order size, order quantity Q. And then the demand for the item is constant. At a particular point, they decide when to reorder. And during the lead time, inventory becomes 0. And then and on the same day, you get the full order. So likewise, it goes up to the maximum level. So that is the behavior of basic EOQ model for each item. So the slope of this line is called usage rate. The middle line here, that is Q divided 2, that is the average inventory on hand according to basic EOQ. This is how we consider the basic inventory EOQ model according to the assumptions identified above. I hope that is clear. Have you studied this before for some other subjects? Yeah. For cost management. Yeah. So it's not a big deal. You know how inventory costs behave at different order quantity levels. So these two types of costs, especially the first one, that is carrying cost or the holding cost. When the order quantity increases, holding cost increases proportionately. The blue line. When the Q increases from low level to high, order quantity increases, holding cost increases proportionately. But on the other side, ordering cost or setting up cost is declining at a declining rate, as shown in green line here. Ordering cost or setting up cost. So the total inventory cost, which is the total of these two, holding and setup cost, would behave like what you see in red line. Total cost of inventory. The total of holding cost and the ordering cost. Accordingly, there's a point that minimizes the inventory cost. Minimizes the total inventory cost. So that is what we consider as optimal order quantity that minimizes inventory management cost. I'm not going to explain the equations and all. You know, this has been proven and the equation is given. Right. So when you use these keys and then considering annual setup cost and the annual holding cost, that is equal at the point that minimize the total cost. So they identify at which point this happens. So accordingly, to calculate EOQ, we have this equation. Square root of D 2 into D into S divided by H. So Q equals economic order quantity. Capital D, that is annual demand. Capital S, that is ordering cost or setting up cost, divided by H, that is carrying cost or holding cost per unit per year. In case if you are provided such details, you should be able to calculate inventory or EOQ equation and identify some simple details like this. Assume that you provided some simple information like annual demand is 1,000 units. Ordering cost is $10 per order. Is carrying cost or holding cost $0.5 per unit per year. By substituting values to the equation, you will get an answer like Q equals 200 units. That means optimal order quantity or economic order quantity is 200 units. You can also calculate other details, other information. If you are provided, say for example, how many number of orders would be required to fulfill this total annual requirement. We know annual demand is 1,000, EOQ is 200, so that fulfill the annual demand. How many orders per year? 1,000 divided by 200, that is 5 orders. To determine optimal time between orders, if you have provided some additional information like how many days that the factory would be operating, or number of working days per year, in this case that is given as 250 days per year they are going to operate. So expected time between orders, from one order to another, to divide number of working days by how many orders per year. So you get the answer like 50 days between orders. If you are to calculate the total cost, total inventory cost, you know the equation, that is both setup cost and holding cost, which are equal at the point. So you calculate the setup cost using this equation plus holding cost. By substituting values, you will be able to get the total annual cost that comes as $100. At that point, both setup cost and the holding cost equal to each other. Right? Hope that is clear. If you have to add the material cost, that is the price of the product as well, what we have to do is add the material cost, like annual demand into unit cost, D into D. So if you are given the unit cost, you can also then calculate the total annual cost using the product cost. These are very simple and you're familiar. I'll quickly move to the next point. That is to calculate the reorder point. That is also important. At which point you have to reorder. Make sure that you get the quantity on time to avoid stockouts. And in basic EOQ, there is this assumption that we know the lead time and that is constant. So we have to consider lead time when designing the reorder. EOQ answers how much to order, size of the order, whereas reorder point specifies when to place the order, as you know. Reorder point, when you should place the next order. And for that, we consider lead time. L. That is the time gap between order placement and order receipt. Could be days, could be weeks. You have to appropriately use it. And usually we consider the daily demand if it is given in days, weekly demand if it is given in weeks. Average daily demand, simple D, into lead time, capital L. How to calculate simple D? That is the annual demand divided by number of working days. That per day demand is calculated, simple D. Multiply it by capital L, lead time, you get the reorder point. Reorder point. So annual demand divided by number of working days. So that you get a simple D and you identify the lead. Given the lead time, you then identify the reorder point, as you see. Right. If you have provided some simple information like this, annual demand for these phones, 8,000 units per year. Assume that they are working for 250 days per year. And the lead time for order is 3 working days. Assuming that the lead time is 3. If you have to calculate reorder point, simple. First of all, we have to calculate the simple D. Annual demand divided by number of working days. Get the answer like 32. If lead time is 3, what is reorder point? 32 into 3. 96 units. What does that mean? Reorder point 96. When the inventory drops up to that level, when the inventory level is 96, you have to place the next order. So within 3 weeks time, 3 days time, you will get the next order in the line price. So those are very simple. In case if the lead time is 4 days, reorder point would be 128 days. Sorry, 128 units. Very simple example here. Can you quickly give it a try and answer these simple questions? This is about a tire company that expect to sell 9,600 radial tires within the year. Annual carrying cost per tire per year is $16, whereas ordering cost is $75 per order. Assuming that the distributor operates 288 days per year and lead time is 5 working days. Did you do this? Calculate EOQ. Identify how many times per year does the store reorder, and identify the reorder point. Identify the length of an order cycle, time gap between two orders, and calculate the total annual cost at the EOQ level. Ignore the material cost because unit price is not given. I will give you 5 minutes because you can simply solve such calculation. Since you can manage the calculations very easily, I'm going to calculate it for you. Please raise your hand or unmute yourself if you want to ask any questions. In past papers also, you might see some similar calculations, maybe similar exam questions. If you know the equations, if you know how to solve them, substitute and solve them, you can easily get full marks for this part of it. But your understanding on inventory management is general. That is what we discussed before the break. Inventory management, portals of inventory management, especially different activities coming under inventory management, other inventory management concepts. Your understanding on those areas will also be tested. That is to these calculations. Fine. Any doubts? Can you manage it? Online participants, is it clear?
Yes, sir.
Right. This is the basic EOQ framework, EOQ calculation that you are familiar with. Let's discuss one more step. Now, up to this point, almost everything, all the calculations are aligned with the EOQ assumptions, basic EOQ assumptions. But practically, those assumptions are not working. There are some advanced models, the one that we are going to discuss next. Now, in them, some of the assumptions are relaxed to some extent, especially the next one. We call it economic batch quantity model, EBQ model, also known as production order quantity model. This is known as EBQ, economic batch quantity, also known as production order quantity model, in which one assumption is violated. What is that? In the assumption, we believe, we identified that once we decided the order quantity, right, the full order should be received. Third assumption here, the full order, that is EOQ. When we order, we should be getting the full order instantaneously complete. Applying this to production facilities like factories, they might decide the size of the production run. That means the size of the batch. That is more economical. Like an ordering, they decide the size of the batch. But they cannot produce full batch within a day. A production run may go into few days time. Assume that 3 days or 5 days. One batch is continuously produced for 5 days, then they stop and change the production. Change another product and change the production process and start producing another product. Now, during the production run, we don't get the full quantity once. We slowly get daily production to the inventory, and on the same day, we will be consuming some amount of them. At the end of the production run, assume that after 5 days time, now no longer you get from the production. You have the maximum inventory now. From there onwards, you consume inventory. You release inventory. Up to some. Unlike in EOQ model, where you get the full order once, in manufacturing setup, there is a period like production run. While you are getting the orders, you consume. And then after some point, once you complete the production run, you only consume. So there are the calculations are a little different. Identifying what is the optimal production quantity, EBQ, economic batch quantity. And the equations and the calculations are a little different. Is that clear? So this is applicable in manufacturing industries, where your production run will go into few days. So you don't get the EBQ at once. Completely. It goes into few days. So this is used when the inventory builds up over a period of time after an order is placed, after a production is started. It is used when units are produced and sold simultaneously. So you have a period, that is a production run, that is the simple T here. We call it inventory cycle. You run it a few days, you get production while you are consuming. After the production run is over, you only consume. So the inventory levels, the maximum inventory level is different from EBQ, sorry, EOQ. And then the relevant equations are mentioned here, which I need to calculate annual holding cost, and then maximum inventory level. Here simple P stands for daily production rate. It is same as above, like holding cost per year. Simple D, that is daily demand, and simple T is the length of the production run, how many days it may go. So how to calculate holding cost? That is using this equation. Don't worry much about them. If you know the equation, you can substitute and get the values. And then equation for calculating EBQ is slightly different from the EOQ calculation. The equation is mentioned in slide number 29. Production quantity model, QP, EBQ, QP, right? Production quantity model. Economic quantity can be calculated using the same equation, but slight difference. What is it? What is the difference? 2 into ds, that is same, divided by h into 1 minus d divided by p. 1 minus d divided by simple d, daily demand divided by daily production. That is the only difference. If you are given the information like this, right, assume that annual demand is 1,000 units, holding cost is $0.5 per unit per year, and setting up cost is, that is $10 per setup, and simple P, daily production, 8 units per day. Daily consumption, simple D, that is 4 units per day. If you are given such information and ask you to calculate economic production quantity level, hope you can substitute values to the equation and get an answer. Can you? Simple as above, but only we consider daily consumption and daily production ratio. And accordingly, you get an answer like 283 caps. Clear? In the same manner, sometimes you will be given only annual demand and number of days factory operates. So you'll have to calculate simple D. Assume you are provided some of these information. And ask to decide EBQ, production order quantity or economic batch quantity, or what we call optimal run size. To be the size of a batch. A toy manufacturer uses 48,000 rubber wheels per year for its popular dump truck series, one particular toy series. The factory makes its own wheels in their production process. They can produce at a rate of 800 units per day, 800 rubber wheels per day. The towing trucks are assembled uniformly over the entire period. That means they produce at a given rate, constant rate, daily. What the carrying cost is $1 per wheel per year. Setup cost for a production run of wheels is $45. That is S. Setting up cost. Assuming that the firm operates 240 days per year, determine EBQ. Use the simple equation we identified above. Only that at least you can calculate the total cost later. Calculate EBQ using the equation. Using this equation. You'll have to identify some values here, especially simple P is given, daily production rate 800, but you'll have to identify daily demand. And for that, what we have to use annual demand, capital D, 48,000 divided by number of days operating, that is 240. Not only that, you can substitute other values. Carrying cost $1, setup cost $45. Those who are connected online, I hope you also can give it a try. For this. Something is not clear. You can ask some questions. What should be the optimal run size for ABQ? I hope that is clear. calculate the MDQ. Done that part? You're the cap. Have you done that part? No. You can simply use this equation and substitute values. 2p. What is simple D? Simple D. 200. 200. Okay. Substitute that value. 200. 200. Simple P that is given here, that is 45. Sorry, no. 800. Production month work into 4 days. I think it's a matter of calculating, you can do it. Coming to total annual cost for both carrying cost and the setup cost, you use the equations here. So to calculate the setup cost, the same setup cost equation can be used. D divided by now QP, right? The Q that you identify into setup cost. And holding cost. Here, when you decide the Q, you have to use, when you decide the average inventory, you have to use this equation. So holding cost equals H into Q into 1 minus ratio between D and P. And arm of it. Add those two together, you get the annual inventory cost. When they operate at optimal run size or EBQ, what is the minimum total annual cost for carrying and setup? I think that's enough for the time being. Right. Other type of production systems, we call them fixed period models. The fixed quantity models, quantity is fixed. Coming to period models, we call them P models. They are the time interval that you check the inventory and pre-order, that is fixed. We call them P systems or periodic reviews. That operates in a way like this. At a regular interval, like P is fixed. You decide what should be the optimal period that you have to check your inventory levels that minimizes the cost. Q may vary, or the quantity will be vary, but P is constant. So we'll study about them future. So what did we discuss here under this inventory management topic in operations management? To smoothly manage operations, inventory management is very important. In one hand, through inventory management, we can ensure smooth supply to the market. and improve customer satisfaction, improve customer service levels. But we have to do it at a minimum inventory cost. Because maintaining more inventories result in higher cost. That is why inventory should be managed. We understood what are the different types of inventories to be managed. What are the different inventory costs relevant? How they behave. And we also identified the purpose of inventory, so functions of inventory management. And more importantly, we discussed what are the key inventory management activities. After that, we discussed two main activities, that is inventory classification. We discussed ABC classification. And after that, we identified different inventory management systems. We discussed only one, that is EOQ mode. One step ahead, we went, that is to identify what we call EBQ models in production setup. And we did the calculations as well. So the content here will also be tested in the final paper. Well, with that, we will be able to conclude our operations management module, since we have to conclude it today. So I will be uploading CA marks as soon as possible, hopefully before 9 or 8 or 9. I have received both assignments now. For the second assignment, there were 43 reports. I will be uploading the CA marks. So probably I will send to the exam unit. You will come. No. Coming to the final paper, more like the same question paper that you see in last few years. Yeah, I have done the subject, especially weekend courses. You will more or less get the same structure. There will be around 7 questions, out of which you have to answer only 5 questions. Including the question number 1, that is compulsory. So it would be around question number 1. The compulsory question would be about the overall knowledge you need to have about operations management in general. Like what is the scope of operations management compared to other functional areas? What are the specific responsibilities, specific contribution from the operation side to the business? What are the key decisions involved in? And then, of course, why managers, like applied accountants, applied accounting students, they are not going to become operations managers. Right? But you should also know about subjects like operations management. Why? Operations management knowledge is important for any type of manager, working at any level. In addition to that, what are the modern challenges faced by operations managers, faced by businesses that they have to address through operations? What are the modern challenges, and then how businesses have responded to those challenges? Right? So kind of overall understanding about operations management, latest trends, latest practices. That type of overall understanding would be important to answer well for the question 1, that is compulsory. So don't skip that. And there will be questions from all other topics we discussed. As you know, there will be descriptive questions. You have to define, describe, explain. And there will be a few questions to do the calculations as well. You can bring the calculator. There will be some simple calculations as well. When you answer, make sure that you understand the question and the expected answer, and then write. Don't try to write everything you know about it. Read the question again and again and identify what is the question and manage the answer accordingly. Otherwise, if you start writing everything you know, you will run short of time. Sometimes I have seen some good answers. First and the second answer, they have taken a lot of time to give comprehensive answers. which is good. But towards end, they have run short of time. So they have probably stopped with 3 questions, 4 questions. Or their final answers, they are very, sometimes very difficult to read, or they have not answered. So try to manage your time and answer all 5 questions. Select questions that you can get full marks. And try to get a good grade for this subject. I hope we managed to cover at least 10 to 12 topics on operations management. That is enough. We discussed how operations management department should contribute to the business success, and accordingly, how operations managers are expected to perform in business. So when you become managers or auditors or accountants, this knowledge, these concepts might be useful. And that is basics what we discuss here. We will study detail later. And thank you very much then. Thank you for coming. Let's conclude our discussion here. Thank you very much.
Thank you very much, sir. All your support and learning things that you have given us. So we got a lot of things that how we manage and operation management, how we import it into the business. So thank you very much once again, sir. Thank you.
Yes, sir. Thank you.
Thank you very much, sir.